Good afternoon, traders. This is Chris Buss with Traders Profit Compass with a weekend Profit Navigator for Sunday, May 1st. Want to wish my son Brian a happy birthday today. As always, please run your player at 1.5x. What I want to do today is take a quick tour around the markets. I want to go over the US dollar, some global currencies. I want to hit the commodity market. I'm going to hit the indexes, and then I'm going to run through the Spdr sector ETFs, and then talk about a little bit about strategy going into the FOMC meeting on the 4th at 2 p.m. next Wednesday. Okay, one thing we haven't talked about very much in recent weeks is the US dollar that has been on a real tear. And as you can see here, we've got a 35-year chart of the dollar. And here we've got roughly a 6-7 year consolidation between, let's just call it 90 and 102. You can see that back in, what was that, 2016, we hit a high of 102 on the monthly chart. We had a pullback, retracement, and basically if you just look at this as a big consolidation rectangle, you can see that we are in the process of breaking out as we speak, as April comes to a close. So we closed right on the highs at 102.96, so let's call it 103, breaking this prior high. And you can see that back on the chart, we haven't spent a whole lot of time since the 90s above this level. And if we just take our TA 101 principles and say, if you break out of a consolidation zone, the technical target is the width of the trading area added on to the breakout. So if we go 90 to 102, that's 12. And if we start at, let's call it 103, that takes us to 125. And that takes out the highest level in over 35 years. Does that mean it gets there? No. That just says that the technical elements are in place for that to happen. Now, a large part of that is that in currencies, it's a ratio game. And if you look at the weightings in the US dollar, it's dominated by the euro and the yen. I think trying to remember here, I think the euro is like 54%. Don't quote me on that. And the yen is about 25%. And then all the other, global currencies are mixed into that basket. And you can see here, if you've been following along at all in the news, we haven't covered it here, but the yen is absolutely collapsing, and it's gone from, let's just call it 93 to 77.50 in a very short period of time. Really, you got to go back in the charts to areas back in 2014 and 2011 to see sharp drops like that in the yen. So, I mean, if we just look at this as a bear flag of this move, you can see that projecting that A, B, C move, if they don't do something to intervene, they've got a program of yield control over in Japan, trying to keep that JJ JGB government bond at like 0.25%, and they're just trashing their currency in order to keep that bond the same. And they've shown no signs of reversing that policy. So this trend looks to be firmly intact until there's some kind of a policy change. If we jump over to the euro, we're at a critical spot. Back down here at this 104.50 range, closing at 105.47 on Friday. You can see that this has been a line of support going all the way back into 2015. You can see we had touches. Didn't really get a touch here, but we got pretty close. And now we're testing that area. And keep in mind that as rates in yields here have been rising, they're still, I believe, in quantitative easing in Europe, believe it or not. So they haven't even begun to tighten. So, if this breaks, you could be looking at a flash move down to 85 on the euro, which really hasn't been seen since the early 2000s. Now, I'll just throw this out there because I was talking about it in the trading room. If you wanted to plan that lifetime trip to Europe or Japan, now's the time to start planning that trip, because if the dollar explodes and the yen and Europe just absolutely collapse, I mean, if you get down to a euro at 85, and the dollar does a moonshot, going to be really, really cheap to go to either of those two places as you convert your dollars into the local currency. It'll be a bonanza for you and a very cheap time in your life to go, because as you can see, it's been half a lifetime. It's been 20-something years since the euro was at 85 cents. And another thing I'll throw out there, if you ever had in your mind, boy, I'd really like to get a Porsche. Boy, I'd really like to get a BMW. Boy, I'd really like to get a Mercedes-Benz. And you see that euro collapse, you go buy it in Germany and then you ship it back, because you'll be getting 20-30% discount on that price based on local currency. And I was sharing with the traders in the room, that used to be a very popular thing in the 70s when the German Deutschmark had crashed and the dollar was relatively strong. There were a lot of people, and I was a teenager, all into Porsches and all that kind of stuff. A cottage industry developed where you could go to Germany or have a broker buy the car for you in Germany and ship it back, and you were getting just an absolute phenomenal discount on that. So just a few, I know those aren't really trading ideas, but that might be something to do for your family if you had always wanted to go to Europe or something. Even right now, you're getting a nice discount versus back here when the euro was 160. It's a lot cheaper now than it was back then. And if this cracks, it's going to get even cheaper. And, one thing you could do is, even if you didn't know when you were going to go, buy some euro when it gets real cheap, and then you can just withdraw it when you want to go, and you'll have kind of locked in that rate, if you will. I want to hit Bitcoin real quick. I'm not heavy into Bitcoin. I had tried a long back in here, hoping for this breakout. Maybe it was right here. Yeah, I bought GBTC when it had broken above the 200, and that trade lasted about 2 weeks and got stopped out. But what I'll say is Bitcoin is like a shark. It needs liquidity and it needs momentum. And when it loses those two factors, it's like a shark that stops swimming, it dies. And we are at testing a really important trend line here at 38,000. If you can imagine this trading area here as somewhat of a bull flag, and you've got a distance here of about 10,000, from 38,000 to call it 48,000. You've got a width of that trading range as 10,000. You get a break of 38,000, and just on a measured move basis, that would be testing 30,000, 28,000. That's, technically not very good. So I don't know what your view is on Bitcoin, whether you're holding it for life or you're a trader. As the Fed removes liquidity, I think it's going to be tough, really tough for Bitcoin in that environment. And you can see the support areas, and I just gave you the technical targets, so be very, very careful there. Moving on to commodities. This is the aggregate CRB commodity index. You can see we are at essentially 10-year highs, closing right on the high this month here at 308. You can see the different levels here at 480 was the peak back in the commodity boom of the early 2000s. We had a peak here at about 370. That was the coming out of the big recession, global financial crisis recession, had a big bounce up to 370, and then it eventually rolled over. So right here, I think we're at a real important spot. It would not surprise me if there are, big slowdown fears and China persists or even expands its lockdowns, COVID lockdowns, that you might see a hesitation here. But I think that would be technically a good thing, from the sense that kind of burn off some of the parabolic kind of look of this chart, have a little consolidation for a month or two, and then explode higher. Now, oil's been behaving really well. All of the commodities, the metals themselves, oil, the grains, all that stuff have been acting really, really well lately. So, it may not. It may just explode from here, given all the supply chain shocks. But if like I said, if global markets really do go into some kind of recession, that's going to knock down demand and prices along with it. But at least that gives you kind of sense of where the charts are. You can see here that the US dollar, as we just discussed, is testing, even beginning to break out of the top of this long consolidation box. And we've been following oil pretty closely. It is, here was the recent peak. You can see that we're at essentially at the highs all along this line here at 105, and then we've got the peak back in '08 of $147. So oil's been acting really well. Again, it'll go along with the global demand outlook, because supplies, as we've been discussing, are very contained. Now let's go into our indicators. I know everybody out there, when's the bottom, where's the bottom, when do we get long, what do we do, all that kind of stuff. So let's take a look at it. Here's my extremometer, put to call ratio inverted. Histogram bars below the green line indicate excessive put buying. Bars above the red line are excessive call buying. As I've discussed, this indicator is a lot better at picking bottoms than it is picking tops. So given that we're making new lows, we're going to watch this really, really closely. Unfortunately, it is not a there's no point on this chart where you say that's the bottom. All you can say is we're starting to see panic put buying, as we head down, and those are signs to be on watch. And you can see that at this level, at the 0.75 level, all you got to do is go back across the charts, and we haven't seen levels like that since the COVID meltdown. So from that standpoint, it is significant. Now, moving on to our oscillators that I put a lot of faith in, because they've treated us so well. I was actually rather shocked to look that after Friday's meltdown, that the oscillators did not really do a nosedive. Yes, they came down from minus 25 down to minus 42, but nowhere near minus 60 or lower, where you'd expect, or where you'd understand that the rubber band is really, really stretched to the downside. So from this perspective, I think there's more to go, or there's the ability to go lower. Why? Because the rubber band is not maxed out to the downside. And we see the same thing on the NYSE, only here at minus 45. This thing could easily go past minus 60 and even down to minus 90. And we were at minus 90 on the February low. So now, as we're testing that February low, where we were at minus 90 and looking for a reversal, here we're only at minus 45. So that tells you there's room on these oscillators to go to the downside. As we move on to the VIX, what I've done here, this is the daily chart going back over several years. Excuse me, this is a weekly chart. Excuse me. You can see that 40 is a demarcation line, if you will, where it has contained most of the runs towards that level in the past, and really only during COVID. And we had a touch here at the February lows at 400, or excuse me, at 40, where it was contained there. We've had very few excursions in the last several years above 40. So sitting here at 33, we've certainly got room to the upside on any kind of follow-up plunges to on tomorrow, Tuesday, or Wednesday heading into the Fed. So I think there's room to go up and at least test 40, if not even break above. And here on our volatility term inversions, we had popped up on that one-day rally on, Thursday, but not really very far. So both of our volatility terms are down in the extreme fear, and you can see that in the past, getting down at those levels have been pretty good markers on where to look for a bottom. So we've got some, conflicting measures, and I don't have it here, but sentiment is very much skewed to overly bearish. The guys that follow that very, very closely have been posting a lot on Twitter and other places that the bearish sentiment hasn't been this bad in like 20, 30 years. The thing is, those are not great timing indicators from the sense that, we're way oversold, or sentiment is washed out to the downside, but that doesn't mean that price can't go lower. And it's not a place to where you say, okay, sentiment's way overdone, we're due for a bounce. That's one thing, but to flip your portfolio bullish is a totally other thing. Position it for a bounce, because I think we could still go lower from here into the Fed meeting. We'll talk about kind of like strategy at the end of the session, but I'm leaning primarily on the oscillators, the NIMO and the NAMO. Why? Because they've never done me wrong. And so each of us, have the things, we're colored by our history. We're colored by the past of things that have worked and things that have not worked. So I'm going to be leaning on those NAMO and NIMO oscillators to when they go, minus 60, minus 90, start peeling off the short exposure and get ready for a bounce. Now let's get into the indexes real quick. SPY weekly, in black here, I've given you the fib retracement levels coming off the COVID low. You can see here, got a bit of a head and shoulders look, but really the most important thing is this ledge of support here at 410 on the weekly chart. And you can see that was a good line of support back here in early to mid 21, where we spent over a month, maybe two, right here along that line of 410 before we finally lifted off. We had a touch here in February, right back to 410. I think 411 was the actual number. And then we had some slightly higher highs, slightly higher lows here for sequential weeks in March, where we made a run at that 410. Didn't quite get there until we lifted off on that bounce. But here we are right back at that level. And depending on how next week closes, will either, break below or slightly stay above. So I think this 410 line on your weekly chart is going to be very, very important. And I want you to take note of this void in the charts here, that on a break of 410, we could easily come down to this 375, 380 area, because I don't think there's going to be really too many people home in this area. Now, we can look on the daily chart here, get a little zoom in. We've got, here's that 410 line. If you go back in the back further into time. You've got a little line of support here at 405. There's a gap down here between 395 and 397 has yet to be filled. And I dropped in a trend line off of these lows that come in right in that area. So while the weekly chart would be open to a run down to 380, 375, that doesn't and probably won't happen in a straight line. What you could see is some kind of capitulation early in the week where you come down, clear out all these stops that are probably down here, possibly even make a run to fill this gap at 395, and then get set up for a truly oversold bounce where we could come up and back test this 410, breakdown back test kind of a move. And I could certainly see that from a technical standpoint. Late last week, I sent out a little note to subscribers on IRA money, how to manage that, showing that the 20-month exponential moving average works really, really well on SPY and QQQ as a way to, as a toggle point for whether to be long or whether to step aside or even short within your IRA, where you just kind of really want to camp out and make sure you're with the trend. And I can tell you I didn't show it, but the SPY closed right on the 20-month exponential moving average as of Friday. But you can see where the Qs made a decisive break below. So from this standpoint, the door is certainly open to come down and test this uptrend off of the 09 lows that would bring the Qs into this 280 area. And then, of course, there would be a big decision point there, whether it breaks below, breaking this uptrend off of the 09 lows. And my point here is being, if you look back at the dot-com era or the great financial crisis era, monthly breaks, if you had gotten out in your IRAs, your 401k money, when you had a breach of the 20-month exponential average, you saved yourself a lot of pain and a lot of money. So we are back at that spot now. Word to the wise, you do what you want, but price has given a signal to be out of at least your QQQ longs in your IRA. Either step aside, or if you care to short or whatever, that's your decision. But a big signal was given this past Friday. Here on the QQQ weekly, I've basically put in this A, B, C measured move, and that points to this 50% retracement level down at 283, and that aligns really well with the chart that I just showed on the uptrend off of the 09 low. That is where that uptrend comes into place between 280 and 290. The 50% fib off of the COVID low brings it in to 283, and as far as retracements go, that's nothing, very ordinary. And you would be able to say then that if it got to the 50% retracement and that held, and then we bounced up, it was, in hindsight, you'd say, yeah, that was just a 50% retracement, and the secular bull market in technology resumes. So that's going to be a big decision point. On the Qs, rough day on Friday, off 4.5%. This bar here on Thursday was a total head fake. We came down, made a new low on the daily. So now these lower levels of support come into play. And we had previously done a measured move down here to 290. We just talked about that. We do have an open gap here down to 305. I think that would be a reasonable target in the early part of the week. I think this gap gets filled, whether it gets filled Monday, gets filled Tuesday. At some point, this is going to get filled, I have a feeling. And so I would be zooming in on those levels. And on the upside, if we break back above that 317.35 area, that would be, cautionary for, active traders that, you break back above, recapturing a level from below is, short-term bullish. But I have my doubts. Why? Because you've got major lows across here. So anybody that got trapped, that's going to be supply on any rallies going forward. I think that 317.35, that zone between that level and 322 is going to be really, really tough short term to break above. When we go on to IWM, we've been saying this had looked the worst for quite a while. Why? Because it's been living under the 40-week moving average here in green. And then on Friday, we got that decisive breakdown below this trading range, which opens the door to a move down towards 170, 165 on the weekly chart. And then that too would be your 50% retracement off of the COVID low. And notice back here that a move back down towards 165 would line up with the pre-COVID highs, which were right here back in February of 20. Just a quick look at the daily chart. Not much different, really, because it shows the trading range and the break below. So as long as price stays below this 187.50 on your daily and weekly chart, the door is open for lower. Now, what I want to do is quickly go through the Spdr weekly charts. XLB is your materials. We had a bull trap here, and this recent month-long action right along the top of the trading area, and now we broke below, is certainly very cautionary, because once you enter that trading range from above where that fails, your target is the bottom of the trading range down here at 77.5. Now the good news is that last week it certainly outperformed, being down only a little more or a little less than 1%, sitting right here on the 40-week moving average. So all things considered, XLB is holding up pretty well. The caveat being the target now, especially if you lost the 40-week moving average that comes in at 84.28, would open the door for a touch down here at 77.50. XLC, remember, is 44% Facebook and Google, and both of them have been absolutely destroyed. And now we are coming in on the measured move target off of this ABC move down to 57.5, let's call it. I have no doubt that it's going to make that little move. I wouldn't be like trying to short that at this point. You either got it much earlier in the cycle, or we had showed this chart a few weeks ago. If you had alarmed 54 and got it, congratulations, that's been a great trade for you. I would stay short at this point and see if you don't reach that measured move target. Here is XLE, all things considered, holding up pretty well. It was off a little bit last week, but nothing like the other sectors. Why? Because oil's been holding up pretty well. So, but we're at a critical spot on the chart. You would not want to see this breakout fail with a move below 73, because then that would open up a move to the bottom of the box here at 63. So be really, really careful. And the one thing I want to point out, that I have made this mistake again and again and again. All correlations are going to 1. What do I mean by that? It doesn't matter if it's a bond. It doesn't matter if it's a good stock. It doesn't matter if it's an oil company and oil is doing good. It doesn't matter if you own it, you're selling it. So people are not discriminating at this point between good and bad. It's sell what you own, sell what you can, and worry about the rest later. Sell now, ask questions later kind of mentality. And we saw that in COVID. We've seen that in other type liquidation events. So be really, really careful. And that's where the underlying commodity, I mean, look at Freeport-McMoRan, look at lithium, look at, any commodity, look at fertilizer, totally destroyed, whereas the price of fertilizer has not changed. But names like Mosaic, Nutrien, those type names, CF Industries, fertilizer names have been destroyed, even though the price of fertilizer has not come down a penny in the last 2 weeks. So be really, really careful with your energy shares, because on any kind of flush move, I think it opens the door down here towards 63. Financials had this $5 wide consolidation. It broke last week. I think we're coming down to this 33 area, and if things get worse, the measured move, $5 wide on a break, takes it from 36 to 31. So, and there is a void in the chart here below 33. So I think the door is certainly open for a move to 33, and potentially even a move to this 30 and a half level on financials. And if you want to, you can drill down into the, within that financial basket is a ton of, from insurance companies to asset managers. We went through a thing the other day looking at Goldman and Morgan Stanley and JP Morgan and those names. They're getting hit hard. So maybe you pick those instead of financials. A lot of times when things get like this, I tend to gravitate to the ETFs for just shorting the basket kind of thing. But that's up to you. Just know that you can drill down and find those large components if you want to look for potential shorts or coming up on a bounce. If individual names are coming up to important levels, you can certainly jump into those names. XLI, $6 or $7 wide consolidation. We went over that the other day. We had a decisive break last week. I think this is going to come down, or the door is certainly open in this void down to 90. XLK, which is primarily Apple and Microsoft, those two have not broken yet. So this ETF is still holding the line here at 141. If Apple and Microsoft break, then you're going to see that in XLK, and then you'll have to decide, do you want to short it via this ETF, or do you want to go individual stocks with Apple and Microsoft? And again, they're 44% of this ETF, and I think the door would be open for a move down to 125. I'm including staples just to show you that there's not going to be any hiding places in this sell-off, and they're starting to hit the safety sectors. Real estate was hit hard last week, 5.6%. I think this is going to come down to 44, where these prior lows are, and then there's a big void in the charts here below. Utilities, we talked about, with bond yields at 3%, why do you want a utility at 3% when the underlying is selling off? That's going to wipe out your dividend like in a day. So why would you want to do that? And for sure they came in and now they're selling off the utilities as well. XLV, very cautionary. Bull trap, re-enters the box, bottom of the box. Bull trap, re-enters the box. I think this is going to 124 at the bottom of the box. We are right here at the midpoint at the 40-week moving average. Probably going to find its way down to the bottom of the box again. And then there'll be a big decision point, whether it's a buy, look for a move back up to the top, or if there's a breakdown, in which case it would target more or less this 115, 116 area. And then XLY, with Amazon's disaster on Friday, this thing really let go, off 7%, breaking down impulsively to these lows. I think this thing is going to find 150 over time with an A, B, C move. So that would be my target there. Now, let's talk about Monday, Tuesday, and Wednesday. I have real doubts that people are going to jump in ahead of the Fed. I think they're going to, one or two things are going to happen. They're going to say, okay, it's been enough selling. Let's see what Powell has to say. I think there's a large contingent of people that are waiting for him to blink. Maybe say something like, well, we're going ahead with the 50 basis point rise, but we're going to hold off on QT, quantitative tightening. And then that could be viewed as a dovish element to the statement, and then that would give people like, well, we all knew it was going to be 50, but now that he said we're going to hold off on QT, that's our buy signal. Or he could say, we're going ahead with QT and we're going to start doing, 90 billion a month like we told you back in March that we were going to do. Nothing's really changed. Inflation hasn't abated. We don't expect it to abate, and we've got to take action to knock it down. And then that'll be, probably viewed as, somewhat hawkish, and, he'll have all the words. But I don't think, I'm of the personal mindset that they've got political cover and actually a political mandate to stomp down inflation, and they're going to do what it takes. And whether I think we do have an oversold bounce coming, but I think it's going to be muted. I think there's far higher likelihood of the sell-off proceeding Monday for sure, and then possibly Tuesday and Wednesday an abatement of the sell-off. Why? Just because a lot of times before the FOMC, there'll be that hesitation ahead of time, and maybe depending on how Monday turns out, if we're down another 3-4% or whatever, that'll be enough for a holding pattern. I would say, in my initial thinking right now, and it could certainly change and probably will 3 times before the Fed, is to, if there's bad selling on Monday and Tuesday, probably cover a lot of those shorts just out of prudence, because at that point the oscillators will have to be, the rubber band will have to be stretched to the downside, and the risk reward of holding those shorts, which would then be pretty deep in the money, I would expect, take those off the table and then recalibrate after the Fed, even maybe take some longs into the Fed kind of thing if there's a stabilization just based on the oscillators, but nothing big. I think we're going to be heading lower. So let's wrap it up there. I hope you got something good out of the video. If you're new to the channel, thanks for spending 45 minutes with me. Hit the subscribe button, the alarm bell. A lot more where this came from. We'd love to have you on the team. Jump over in the show notes. There's a link there to add your email address. Join the team officially. That way, morning, noon, or night, weekends, whenever, if I have a thought on the markets, I will send it your way and you'll get it right in your email box. So let's wrap it up. Have a good rest of your weekend, and all eyes on futures tonight and tomorrow morning. If I see something tonight, I'll certainly shoot it out your way. This has been Chris Butts with Traders Profit Compass. Talk to you next time.